All right, so welcome you all to Target IFRS room. Here it's a room of 4 IFRS sections, and these are predicted IFRSs or suggested or estimated or likely IFRSs that's likely to drop in your case, both for financial reporting and corporate reporting. ICAG exams, November 2023, coming exams. As for public sector, the IFRSs will dealt with when you go to public sector class. First of all, before we can predict or estimate the coming exams IFRSs, we first, based on our predictions, what happened last sitting. In July 2024, we predicted all these standards, and out of the one that dropped, 1, 2, 3, 4, 4 out of 5 dropped. So that is that. Even the one that dropped, which was not on our list, IFRS 2, that the same question was solved in class. And I still remember the answers off head during July examination preparation. We had 64, 250 Ghana cedis. It's part of the answers we had, and it dropped in exams, though it wasn't part on the prediction list. So we can say that 5 over 5, 100%. So this trip for corporate reporting, the same badge again, you should get IAS 19 under consolidation. Yeah. Under console. IFRS 5 on its own. IAS 23 on its own. You should get IAS 38, 12, and 37. Only one should be there. IFRS 15 should drop again. This time around, under console, not on its own. Take notice. IFRS 15 won't come on its own. It's under console. And there was a question we solved. There was a console question we have solved here called target group. And that question contains an IFRS 15. Good. Then this is for your question 4B. You see, this one is for question 4B. Question 4B. You will get IFRS 13, IAS 21, or IFRS 10. Last sitting was on IFRS 3 business combination. So that is that. So I'm done with the game. Then for financial reporting, most of our standard did not appear. We had only 2 out of 5 standard that came. Surprisingly, our first standard on our list was their first standard. Almost every time it has happened to us severally. The first standards we put on our list is the first over there. So watch that one also for us. Then they had a question on IAS 1. Even with IAS 1, there was an iota of deferred tax inside, which was IAS 12. So I can say that IAS 12 also dropped, but I will not put it there. They also have IFRS 15. I don't know why IFRS 15 decided to vanish from their list. But let's do that way. Then they had IAS 8, which not appear. Then IFRS 10 control. That one was a direct and specific question. Last 2 sitting, we actually typed the question and it came word by word. It was question 5C. Last sitting to the same thing happened. And this sitting to the same thing will happen. So this sitting, what do I place there? That's why there's a consolidation issue. This sitting to, I'm still putting IFRS 10, consolidation is on control. And I will type the question for them. So I've shared a question, a particular question on their page, specific question on the IFRS 10 on their page. That question I shared with you, please handle that with care and restrict the sharing just for your own good. I'm done with this. So these are the standards that when you go through it, you should be fine for your exams, this trip for financial reporting. Then our intervention kickstarts coming Monday and Tuesday for corporate reporting, Wednesday for advanced audit, Thursday for man accounting, Friday for PSA, Saturday for case study. You cannot afford to miss this intervention. All right, so all interventions start from 7:30 a.m. up to 9 p.m. with the exception of the Monday, which starts from 10 a.m. Thank you. We'll give you the lists. So to join us, the intervention is free, but the material is not free. The intervention itself is free. So you can enjoy the class, share with your friends. Everybody join. Share. Don't pay for anything. Registration is not required for the intervention. However, to get the material, that one, it is a paid version. But if you're already in our class, if I've registered in our class, we know our members. So for that one, and you are not having any balance, the material is free for you. You don't need to pay anything for the material. It's only those who join us who are not from our class, they have to pay for the material. And each material is going for 150 cedis per subject or per paper. So to get access to any of our materials, that is what you have to do. However, we may put some of the videos on YouTube for you to also watch it there for free. But some of the videos are sensitive, so we might not be able to put it there. It will be on our drive. So I'm done. All right, so now let me start today's section. Today I'm going to talk about IAS 23, that's borrowing cost. If time permits, we'll do IFRS 9. But however, I will share IFRS 9 and some important video on your page for you. Please try and go through. It is the intervention video for last trip. So let's start with IAS 23. Borrowing cost. Borrowing cost. Borrowing cost. Borrowing cost. So that is what we have to look out for this morning. When you talk about borrowing cost, IAS 23, first of all, we should know what comprises of borrowing cost. What is borrowing cost? What is borrowing cost? You see, so borrowing cost refer to all costs incurred in securing in connection with securing for finance. That is what a borrowing cost is all about. So if you are going for finance, securing for finance, any cost that you will incur is referred to as what? Borrowing cost. I'll give you the rule, what you need, then we'll zoom into the computations. So take notice of that. Kindly share the link to your friends. Let them have it. Thank you. Borrowing costs refer to all costs incurred in connection with securing finance for finance. In simplest language, if an entity wants a finance in a form of loans, debt or loan finance, cost of using debt or loan finance is called borrowing cost. Please, it is not the principal. If you borrow money from someone, the principal part is not part of the borrowing cost. We beg you. The principal part is not part of that. So here it includes one, mention examples. Interest, facility fees, or processing commitment. Facility, processing, commitment fees. That's it. However, or examination focus. For exam focus, under IAS 23, we are interested in exam focus is on interest. I'm done. So the examination focus on IAS 23 is on the interest element of it. So take notice of that. Okay, so that is what we have now focused. So now the interest, it is the borrowing cost we are talking about. But please, in reality, borrowing costs go beyond the interest. It refers to any cost at all that you incur if you are using a debt finance. Sometimes you see the company's director have to drive all the way to the banks to have a meeting with the manager. Even the fuel cost of driving to the bank for a loan alone is part of what? The borrowing cost. Then, now let's go to the accounting treatment of borrowing costs. We call it recognition. Recognition or accounting treatment. How do you record borrowing costs? That's a recognition. You see, accounting treatment. The word recognition means two things. How do you record it? How? The how answer the question of the real. Is it an asset? Is it a liability? Is it revenue? Is it an expense? That is a how. So if you are asked to discuss the recognition of borrowing costs, the examiner just wants you to tell him the accounting treatment or how do you record it. Then the when, it also talks about when. Then when is the conditions. So recognition also means conditions for recording the item. Every item in accounting has a specific conditions. So that is that. So now let's go through the how. We are the how side, the accounting treatment. There are two types of the accounting treatment. We have the traditional or benchmark treatment. Then we have the allowed or the alternative treatment. So let's pick them one after the other to look at them. I'll finish with the rules, then I zoom into question solving. All right. So when you say traditional, before IAS 23 came into being, what was the accounting treatment of borrowing cost? So that's what we mean by the traditional treatment. So let me put the traditional here or the benchmark treatment here. And let me put the allowed or the alternative treatment also here. And now let's do the analysis together. Now, before IAS 23 came, there was interest expense. How do we treat? What was the treatment? You see, IAS 23 came in December 1993. I remember in 93. That was when the first time IAS 23 was released. Though it came in somewhere March 1984. It was replaced. The one they released in 1984. So the one we are using now came in 1993. But there was a first one that we were using in 84.
Are you there? Oh, yes, please come. I'm reading. Last night I picked back.
So that is that. So before 1984, how do we treat interest expense? That's a benchmark. So here you tell the examiner, use capital letters. All borrowing costs are expensed as what? Finance cost. So before 93 or 84, all borrowing costs, we expense them as what? As an expense in the P&L. Now let's go to the allowed or alternative. So here it started after 1984 through to 1993 till now. That is when the alternative treatment started from. So here some of the borrowing costs are capitalized. That is some of the borrowing costs are capitalized. So you must know which borrowing costs are qualified to be capitalized. Please, here we are not capitalizing all borrowing costs. No, those who meet the conditions or the criteria. So borrowing costs that meet certain criteria, they are capitalized. So that's the difference between the two. So even in today's dispensation, we will still have borrowing costs that will still be expensed or capitalized. If it doesn't meet the condition, you expense it. I'm done with the treatment. Now, I'm going to walk you through. I'm done with the how. How do you treat borrowing costs? That's the how. 11, the when. The when are the conditions. Okay, so you have a question. You can chip your question, please.
Target, good morning.
Good morning.
Hello, good morning.
Good morning.
Please, the capitalized borrowing cost, what will be the accounting treatment for the capitalized one? I know you debit PPE. The other leg of the transaction will go where?
Good.
The borrowing cost that you are capitalizing.
Yes, please. You have already credited your cash book or your bank because you have actually paid it. You have paid the interest to the bank. So when you are paying the interest to the bank, you have credited the bank already. So now you have the debit entry. So the debit, either you take it to your expenses, because expenses also have a debit entry, or you debit to PPE. the focus on borrowing costs is normally not on the credit side, not on the source, because no matter what, you will pay the borrowing cost, you will pay. And once you pay, you credit your bank. But the focus is on the debit side. Are you treating it as an expense or as an asset, capitalizing as an asset?
I've seen a solution where they added it to finance cost in the P&L.
Yes, so that is why.
Is that right?
Yes, it is right. That is why we have explained that there are two types of the treatment. We have the traditional method or the benchmark method. Traditional method, all borrowing costs goes to finance cost. But as I'm now talking to you, coming into being of IAS 23, this one, the allowed treatment is also known as IAS 23 treatment. That one, some of the borrowing costs are capitalized as an asset. So it means that not all borrowing costs. So we can still have a borrowing cost in today's dispensation, which doesn't qualify, which doesn't meet the condition. So all borrowing costs you incur today that does not meet the condition, you classify them as the traditional one. You classify them as finance costs. So even today, if you incur a borrowing cost which doesn't meet the condition that we are about to learn under IAS 23, you cannot come and put it under cost of the asset. Please, I hope it's a bit clear.
Okay.
Here we are not saying all borrowing costs automatically should be capitalized. So we have stopped the finance cost. No, that's not what we are saying. Not at all. We are not saying that. We are saying that some of them who meet certain conditions. So here, based on the recognition criteria, based on recognition criteria or conditions. So if you have incurred a borrowing cost and doesn't meet the conditions, you still go back and treat it the traditional way. So it's the conditions where we are going to learn the conditions. They are 3-step conditions, 3-step. The conditions are in 3 steps. As soon as I'm done the condition, I'm done borrowing costs. I start solving questions with you. And that's the end of borrowing costs. Any question? I hope it's clear. Or it's not clear.
It's clear.
Good. All right, so now let's start with when. We are done with how. When they ask you for recognition, the examiner is looking for how, when, and how, when is called accounting treatment. Yeah. So when they ask you to discuss the recognition of borrowing costs, they want how, when. And if you put how and when together, we get accounting treatment. So now I'm done with the how borrowing costs are being treated, treat methods. Now let's go to the when. When normally talks about when do you commence, when do you start capitalizing, when do you stop. So when is about the conditions. When, let me start like this. Conditions for capitalizing borrowing costs. Then we are good to go. Conditions for capitalizing borrowing costs. Basically, we have the scope. Please, here it does not apply to, let me make it so clear, it does not apply to imputed cost on equity. Please. It does not deal with actual or imputed cost of equity. Please, cost of equity is not part. IAS 23 doesn't deal with cost of equity. So for example, if you raise finance, you see there are two ways of raising finance. If you're raising finance through debt, you have borrowing cost. If you're also raising finance through, let's say, equity, you can also incur a borrowing cost. But here you are not borrowing money, you are raising finance through equity. So all the costs you incur raising finance through equity can never be here, we beg you. Because equity is not the same as borrowing, it's not the same as debt. If you cannot classify what about preference shares? Let me explain this. What about preferences? Before I go to it, what about preference shares? Preference shares. You see, there are two types of preference shares, right? Redeemable and what? Irredeemable. Which one is equity? Which one is debt? Which one is equity? Which one is debt?
Irredeemable behaves like equity.
Good. And this one is what?
A liability.
Good. So this one qualified. This one does not qualify to be part of borrowing cost. Does not qualify. Agreed. So they can go and use preference share to finance construction assets. So don't.
Target.
Yes, please.
The irredeemable preference share. What is the difference between that one and the equity? If it is irredeemable, it's just behaving like equity. I want to know what is one thing that makes it different from equity. Even though we always say it behaves like equity, what makes it not to be equity?
Okay, you see, they said no matter how when grow big and dangerous, it can never be like snake, true or false.
No matter what.
No matter how big worm grows, how scary it becomes, it can never behave like snake, true or false.
True.
So even though all of them are in the same category, none of them have legs. All of them go zigzag way. Good. So equity. You see, preference shares, the reason why there's another name that we don't call it. And if you call that name, it makes it so clear. Equity has two forms. We have what we call the ordinary form and preferred form. So the ordinary form is called common stock. Common stock, and that is what we call the ordinary shares. They are the real owners. Then we have some equity owners, equity holders who don't want to be part of the owners. So preference shares, irredeemable, behave like equity because one, it will never be paid. It will never be paid or redeemed. Because equity, you can't take if you take your equity, you are going away. You don't have any stake. Good. That is it. And the reason why the difference between the preference shares or irredeemable preference shares and ordinary share is that it's about the dividend payment. Dividend payment and voting rights. Per the Companies Code of Ghana, clearly stated, the dividend to preference shares or class of preference shares is fixed. So the preference shares holders can estimate their dividend even before it's being paid. And they cannot vote. They have no voting right. So that's the difference between irredeemable preference shares and ordinary shares or equity, normal equity. The reason why we say it behaves like equity because it will not be paid. Equity is not something that you can get your money back. It grows and gives you return. Unlike that, when you are fed up, you can take your money and go. But equity, you can't take your money and go. You can only sell your shares to someone else to go. Or unless the company wants to do what you call a restructuring phase and they'll do what you call buyback. There's what you call buyback. A company can buy back their shares from you. And then that is all. Please, I hope it's a bit clear. Or I've where's the case?
It's clear, pa.
Good. So that is how it is. It's under IFRS 9. We call it special case of preferences. If I want to make it so clear well for you, even with the redeemable, there are two types of redeemable shares. We call something option to redeem. Option to redeem. Who has the option to redeem the preference shares? We have the holder. Who is the holder? Holder is the same as the purchaser, the one who bought the shares. Then we have the issuer. Issuer is the company who issues the shares. So hence, if the option to redeem, the power to redeem the shares is with the holder, then we say it's a debt instrument. But if the power to redeem is with the company, he will never call for it. So now one is still under equity. So even if I want to worse the case, we still have a redeemable preference shares which can be classified under equity. That is when the examiner go deeper and tell that the company has the option to redeem. So that is that. I'm done with preference shares. So preference shares don't qualify to be part, especially if it doesn't qualify to be part of a debt, it doesn't qualify to be called a borrowing cost. I love this. Though ICA examiners have not reached this level, but I know that one day, they'll reach this level. Please, borrowing cost does not apply to agricultural qualifying asset measured under fair value agricultural assets, and does not also apply to inventories that are manufactured or otherwise produced in large quantities on a repetitive basis. Repetitive basis, please. Good. So take notice of that. Now, let me go back to the when you can capitalize this so that I can complete it for you. Conditions for capitalizing borrowing costs. There are three in number. We have when conditions for when to start or commence. 2, when to pause. When to pause. 3, when to stop. What is the difference between pause and stop? When to stop or cease? Yes, temporal suspension. Temporal suspension. All these have condition. Here there's 3. When to start has 3 conditions. When to pause has 1 condition. And here there are 1.5 or 1 condition. So in all, there are 5 conditions you have to learn. And that is all. When I'm done with this condition, I now start with your computation. Pick 2 questions, solve them, and run away. All right, so let's go straight to the game. When to start? So let me pick the one after the other. So when to start? Let me do when to start here. When to start. Condition number 1. So borrowing cost, you can only commence your borrowing cost when borrowing cost has been what? Incurred. So that's the first condition. So borrowing cost must be incurred. So I'm done with that. Let me arrange them well for you. The standard says specifically, another one says that when the expenditure has been incurred on qualifying asset. But before I start with all this, you see, the borrowing cost incurred in the construction of a qualifying asset is the one that we capitalized. So that should be the first statement I should have made here for you. That the borrowing cost under the alternative treatment, under the allowed treatment, borrowing costs incurred on the construction of a qualifying asset is the one that we capitalized. Please, I hope you understand. So kindly write it down for me. Borrowing cost incurred on the construction or acquisition of a qualifying asset. Borrowing costs that are directly attributable to the acquisition, construction, or production of what? Of a qualifying asset. That's all. Any other borrowing costs are recognized as an expense in the P&L. We are done. So if they are not directly attributable to the borrowing cost or attributable to the qualifying asset, you cannot capitalize it. On that note, I'm done. Now, when to commence? The entity should begin the capitalizing borrowing cost as part of the cost of the qualifying asset when expenditure has been incurred, when it incurs expenditure for the assets, when to start capitalizing borrowing costs. So start by saying when expenditure has been incurred when expenditure has been incurred. Number 2, when borrowing costs has also been incurred. So when borrowing costs has been incurred, borrowing cost has been incurred. Then number 3, Yeah, take notice. So here, third examiner, that when the activities, you see, when the activities that are necessary to prepare the assets for its intended use or sale. So when it undertakes, when the activities are going on, good. So when the entity undertakes, when the entity undertakes the activities necessary to complete the qualifying assets. To complete the qualifying asset. I've mentioned qualifying asset. Please use the name of qualifying asset. Qualifying asset, IAS 23 define qualifying asset as asset that takes substantial time before it will be ready. Asset that does what? Takes substantial time before it will be ready. So when you say qualifying asset, that is what we are referring to. Qualifying assets. Asset that is not ready made. So if you borrow money to go and buy a vehicle at the garage, it does not qualify to be called a qualifying asset. If you borrow money to go and buy a building, a real estate, at least say Heaven's Garden, it is not a qualifying asset because they are done building it already, so there is no need for you to worry yourself. But if you borrow money to go and give it to a car manufacturer that, please, I want a car, mold it for me. Yesterday, I had a meeting somewhere and I was told that there's a new models of vehicle that if you winkle your eye, left corner, to one side of your eye, if you winkle it, it will start your car for you. A car that when you give it, use a fingerprint to start. A card. I think Tesla use a card. Yeah, Tesla use a card. So I thought we have seen it all when Tesla brought their card, not knowing there are more coming. So if you borrow money to give you to a car manufacturer to manufacture a car for you, it's qualified to be a borrowing cost because it will take time before the car will be ready. If you borrow money to go and develop a land, it's a borrowing cost. But if you borrow money to go and buy a land, straightforward, and start building, the building cost, that one, yes. But the land, because the land was already ready. So take notice of that. And you start when the expenditure has been incurred, meaning that you've actually started paying for the bills, construction costs, building costs. Some of the cars, they are done building. But if you go, they have to do certain features for you. The customized vehicles, they are done. But they have to customize it in your name, fingerprint, your ID, your body part. Yes, so those ones to qualify. When borrowing cost has been incurred, meaning that when you have actually paid the interest. Some of the loans, government interest-free loans, do not qualify to be part of borrowing costs. Government interest-free loans, take notice of that. However, government subsidized loans qualified. The entity undertakes that, meaning that the activities are in progress. Work have started. Work is going on. That is when you start capitalizing borrowing costs. I'm expecting this write-up for level 2. Which you mutain for level 2, this write-up. I'm slightly suspecting it. Because it has been exactly 7 years it came. Exactly 7 years. November 2017. Question number 2, it dropped. And exactly 7 years is November 2024. Yeah. Now, when to suspend? When do you have to suspend? That's the B. When to suspend or pause? When do you have to pause capitalizing your borrowing costs? Here, when you say pause or suspend, we are not saying stop. You are pausing for the meantime. You're only pausing for the meantime. When do you have to? We talk about commencements. Tell the examiner that an entity shall suspend capitalization of borrowing costs during the extended period in which it suspend active development of the qualifying assets. So here, rear-ended. So you suspend when the entity temporarily suspend the active development of the qualifying assets. So please, when you actively suspend the development of the qualifying asset, you have to stop. Maybe extended period. Qualifying asset. Please take notice. Yeah, let me explain. There are 2 issues here. Number 1, when it's part of the plan work, maybe the suspension was as a result of plan works. For example, technical and administrative work. Do not suspend. Go ahead. Let me repeat. Imagine we pause because of technical and administrative work. Please, that one, you have to continue the capitalization. Because it's part of to get the asset ready. For example, I am building a story building. And you know story building, I'm done with the ground floor, first floor. To go to the floors, I have to put on the pillars first and wait for some time for the pillars to get dry before I will now add the blocks to the spaces between the pillars. So between those periods for the pillars to get dry, it's part of the plan work. So even though I have suspended active work on the site, it's part of it. Another example is when technical supervisors have to come around to come and inspect the building. For every 2 floors, we have to pause for 2 months for inspectors to come, supervisors to come and inspect whether we can move on with the next floor. So you have to satisfy, because something work satisfied. We have to satisfy the work we have done before we can move on to the next floor. In that case, you don't need to suspend because part of the plan. However, due to unplanned work, you suspend. So the active work during the qualifying, I said, if it's as a result of an unplanned, nobody planned, unplanned activities, unplanned. So unplanned work such as what? Give me examples of things that can cause a stoppage to your construction. Meanwhile, you have not planned for it. Give me 3 activities, 3 circumstances, 3 situations where it can pause your construction. Meanwhile, you've not planned for it. Number 1, shortage of raw material. Number 2, strikes. Strikes. There was a building at Christian Village, closer to Pure Fire Church, heading towards Gimpa Road on Hacho, just before the Hacho Junction. I remember in 2012, there was a Chinese company building. They told us that they will use less than some few weeks to finish the building. When they built, it collapsed. When they built, it collapsed 3 times. It even killed 1 person, one of the workers. Because they were working day, night, dawn, evening, weekend, every day they are working, and the building collapsed. So after the 1 person died, they stopped for a while and went back and planned well and come back. I'll show you that building. Now they are done with the building. They do a lot of stuff. They say, I think one of the plazas. Yes. So in that case, please, can they suspend? Because when they build, it collapsed. When they build, it collapsed. 3rd time. The 3rd time, it killed a human being. So after it killed a human being, they pause. I think for about 2 or 3 months. And they plan well. And they come back again with a full vim. So within that 2 to 3 months, please, can they suspend the capitalization or they can go ahead? Suspend or go ahead?
They have to suspend.
Good. They have to suspend because this is not part of what? Plan work. I'm done. Then the last one, when to cease. This one's for level 2. For level 3, no exam now. Even if we are dashing mark, we will never ask you for the condition. We will never do that. It's a big mistake for the examiner to do this at level 3. We will not do it. But rather put it in a practical case scenario. That is all. To test and see if the final level student can apply. But for level 2 financial reporting, we'll ask them for them to write it for us. When to cease. When to cease capitalizing borrowing costs. Cessation of capitalization, when for you to stop. when to cease. Here start with when all activities, when all activities or substantially all the activities necessary to prepare the qualifying asset for its intended use or sale are complete. Yeah. So when all substantial activities, when all important, valuable activities necessary to complete to prepare the qualifying assets for its intended use or sell. It's not every asset that we build to use. Some of them we build to sell. Or for sale are complete. That's all. So here you stop when you are done. Some of the loans, let me be very practical over here. We took the loan here, the loan. That's when we took the loan. And that is where borrowing costs, we started paying the interest. The very first day, January 2022, that's when we picked the loan. And interest started from there. Then somewhere March, construction started. Somewhere March, construction started. Our first payment was made 31st March. But construction started 1st March. I just want the question to be a little bit complicated. Construction started 1st March. Okay, so let me make it so clear, practical. We made a payment on 1st March. We paid the contractor on 1st March. Then he started the construction on 31st March, end of the month he started. Because when he took the money, he must also take the money, arrange his boys, buy materials, buy this, that. Then he finished the construction October 1st. 1st October, construction completed. Finishing started in finishing. We used 3 months to finish it, 3 months. So up to December. So finishing started from October to November, December. So December we are done. Or let's say 2 months. Let's make finishing 2 months. So October and November, we finish the building. October, November, finishing. Then December, we started using the place December. Then we pay the loan somewhere next year, June, the following year, June the following year, we pay the loan. So the interest run up to next year, June, because for them, once you have your money, once the money is with you, you will still be paying the facility. I'm done. So now take notice. So when can I start? When can I stop? When can I suspend? I've not created suspension yet. Let's assume that on the month of May, in the month of May, there was a lockdown by Ghana government during COVID-19 or whatever happened. There was a lockdown or a curfew in that area, like Bokun, Salaga, Sisala, Mampusi, Kusasi areas. There was a lockdown, total lockdown. Nobody should come out. So as a result, management of the construction firm switched their inspection. So they used that month to do technical inspection. That is all. This is a very nice question. So please start for me. When do we have to start the capitalization? When do we have to suspend or we should continue? When do we have to cease or stop? Per what I've explained, tell me who can do it so that I start my calculation. Please, who can start for us? It's a complicated story. The recent question, your examiner did that. Number one, January, we took the loan from the bank. Then we're verifying the supplier's list and agreement. First March, we signed the deal with the contractor, and we paid him 50% of the amount he required. But 31st March, he also assured us that once he has gotten the money, he must get some materials ready. So he used 1 month to get his materials and everything ready. And 31st March, he started the construction. So where can borrowing cost start? When can we commence borrowing cost? Is it when we paid the contractor or when he started? Or when we took the loan from the bank? Because to start, you need 3 conditions. First, there must be an expenditure. An expenditure. meaning that you have paid. You have not that you have paid, or you have incurred. You started owing an expenditure. So that one can be as when expenditure started on 1st May when you signed the contract. So this is where expenditure was incurred. Number 2, when borrowing costs has also been incurred, when do you start paying the interest? You started paying interest right from the day you took the loan, January. So interest. Then when the active work as when the entity undertakes the activities. So when do you start the construction itself? Construction started from March. So construction started from here, activity started from here. Hence, they can start capitalizing on this day, that 1st March. Agreed. So you can start the capitalization from 31st March going, because that is when all the 3 conditions can be satisfied. Please, all the 3 must be there at the same time. All the 3 conditions should be there. So the day that all the 3 started moving together, that is when you can start the capitalization. I'm done. Then in May, there was a lockdown, which is supposed to suspend construction because nobody planned for lockdown. However, management were very fast and they used that period to do what we call technical supervision. So hence, they will not suspend. They have to continue capitalizing borrowing costs. What a wow. So I'm done. Finally, on October, they are done with the construction, but they have not finished the building. Construction was completed. Now, finishing came in. So they used October and November to do finishing, meaning that to bring in curtains, the tables and chairs, arrangement, and December, they fully moved in because December was their birthday. Please, when can they stop? Is it when the construction is done or when they finish the finishing or when they start entering in? And when does depreciation start? Let me even continue. Please. Please, I hope you are following.
So when it was ready to be used.
So is it when the construction is completed or when the finishing is completed?
When the finishing is completed.
But not when construction is completed. All right, so you are right. When finishing is completed. So borrowing cost should end in November. So November, borrowing cost should end. They should stop capitalizing borrowing costs in November. So where do you think they should charge December's borrowing cost to? December's borrowing cost, where do you think they should
Finance cost.
come again?
Finance cost.
Finance cost. Good. Good. What about the next year, January up to June, because the loan was repaid in June? What about the following year, January to June interest? Where will they go? Still
Finance cost, yeah.
good. When do depreciation start from? Is it when they occupied in, or when they are done with the assets? Depreciation, when will it start? Is it when that they start using the asset? Please here use red pen to write it. Depreciation to start. Depreciation should start when the asset is available for use. Depreciation should start when the asset is available for use or ready to be used, but not when the asset is brought to use. This one is accountant terms. Understand? We don't charge depreciation, or we start depreciation as soon as the asset is ready to be used or when it's available. So here, when do we start depreciating the asset? Is it November or December?
November.
November. So the day that they said, I am done with the asset is ready for its intended use, that's when depreciation step in. I'm done with borrowing costs entirely. There are some disclosure requirements. You disclose the rate, the capitalization rate, the amount capitalized, and the carrying amount. When they say do the disclosure requirement, capitalization rates. This one is for the level. The amount of borrowing costs capitalized and the capitalization rate, that's all. So borrowing costs have only two disclosure requirements. The amount of borrowing cost capitalized, then the capitalization rate, that's all. Now let me go to the calculation and then pick one questions to discuss it. There are two types of borrowings. In fact, can even have three.
Target.
Yes, boss.
Please, is the FM coming on?
Yes, please, right after this. So
Okay, thank you.
great. Now, what happened is that we have specific borrowings. And we have general pool of funds. General pool of funds. We call it existing borrowings. Once you are getting borrowing costs, you have to be versatile to look at it. Then we have the mixture, the hybrid. You can have partly specific, partly general pool. When you say specific borrowings, here taking fresh loan to construct a qualifying asset is called specific borrowings. Here you take a fresh loan to construct a new qualifying asset. Fresh loan for a new qualifying asset. That is what we call specific borrowing. I'm done. Then general pool of fund is when an existing borrowings, you have a surplus funds. You've been borrowing some funds. You went for a loan some time back. You have used some of the money is still available in your bank account. When some of the money is still in your bank account, then it means that the money is idle. So you can use the existing funds, that's existing borrowings, to also construct the qualifying asset. That's what we mean by general pool of fund. Here, because you are taking a fresh loan, the capitalization rate will be equal to the bank's interest rate. Use the bank's interest rate. But here, the capitalization rate is equal to the WACC. You have to calculate the WACC. Weighted average cost. Weighted average cost of debt. It's supposed to be weighted average cost of debt. So this is how it's supposed to be. Weighted average cost of debt or cost of capital. That's the capitalization rate. In summary, before I pick my question, there's a small format for all of them. Then we are done with borrowing costs entirely. With the specific borrowings, you start with the interest expense. So much. Less investment income. Investment income from temporal investment of the surplus funds. Sometimes you invest. So this is the borrowing cost eligible for capitalization. Bring the loan amount here or construction cost here. You get the total cost of the asset. Total cost of the asset after construction. Then you can now start your depreciation. Then you now get current amount of the assets. Current amount of the assets. That is how specific borrowings, the format look like. With the general pool of fund, here the issue has to do with one, the capitalization rate. Then you bring your interest. Start with your interest. You use the month, the period. Here, the period of borrowing is the most important thing to us. Maybe period 1, period 2, period 3. And then you put them together. That's all. Then you now continue with your, this is the borrowing cost eligible for capitalization. Then you continue with the rest. the construction cost, and then the likes comes in. I'm done. For this, you should be fine, but let me pick one full question to do. I've done a particular question on the YouTube there. It's very interesting. So please, after this, look for that particular question in order to complete the story. I have a question which is going for $200. If you solve it to the end, I have the marking scheme here. Come for full $200. As at 2018, it was $50. 2022 increased to $100. 2023 was $150, and 2024 is $200. We still have not gotten anyone to produce the answer for us. We have the marking scheme here. Now, to get the material, log on to the portal. Any of the portal, you should have access to it. Either financial reporting or corporate reporting portal. You have access to all these materials. So let me log on to corporate reporting portal. That's the 2023 portal. And then pick just one question and solve and move on. Come on, my first question. There are a lot of questions. Nice one. You can solve. I'm on the 2023 portal. Go to the books and notes. Come to the notes. You see there. It should be part of standard 2, financial reporting standard, FR standard 2. Borrowing costs is there. So this contains IAS 16, 20, 23, and 40. So 23 is the borrowing cost. All questions you need to have. I think it's the last in the material. It's the last in the material. All right, so this is the borrowing cost questions. They are meant for you. Let me pick one. The question 12 is the one that you have to solve for $200. This one, this particular one, $200. Solve it for $200 for this. Then we are good to go. All right, so the question I'm solving is here. Where? There's a particular question. It came in November 2020. And then we are good to go. Okay, so we are solving question 4. So question number 4 is a mixture of the two. So question 4 is what we are doing now. It's corporate reporting 2016 past question. After this, I bring the curtain to a successful end and add your material. Please don't forget that we're having our intervention on next week, Monday, Tuesday, and then Wednesday, down to Saturday. Sunday is emergency meeting for financial reporting and corporate reporting students. Sunday, emergency meeting. So instead of me meeting you on Monday, I'll not meet any student. Sunday, I'll do the whole show. I'll run you through all of them with you on Sunday before your paper. Then I'll vanish. All right, so let's go straight to the game. It said calculate the amount of borrowing costs to be capitalized. And then I'll go further to calculate the carrying amount of the assets after the first year. And then we move on. The ABC Limited commenced the construction of a new office block 1st January 2010. The following payments were made. When was the first payment made? Please, when was the first payment made? It should tell you clearly where you should start your capitalization. Where exactly? The first payment was made on 31st of January. Not the same day. The construction started from 1st January. So the payment started here. So therefore, borrowing cost should be capitalized from 31st of what? January. I love that. Now let's go. They said that the first payment on 31st January was funded from the enterprise pool of debt. When you say the enterprise pool of debt, that means general borrowings or general pool of debt. However, the enterprise succeeded in raising a medium-term loan for an amount of 800 Ghana cedis on 31st March 2010 with a simple interest of 9% per annum calculated and payable monthly in arrears. So that one started from here, 31st March, 800 started. That one is specific borrowings Continue the story. Say the funds were specifically, used for this construction. That made it a specific borrowings. The excess funds were temporarily invested at 6% per annum or monthly in arrears and payable in cash. What you? If you borrow 800 at 31st March, and on that day now they use 450. How much left? How much was free? Do those calculations. Yes, that's what we call the excess funds or surplus funds. And then we are good to go. Now they say the pool of debt was again used to the amount of 200 for the payment on November, which could not be funded from the medium-term loan. So you see, if you pick 800, realize that as at 30th November, I left that much. Let's do the computation together. 800 minus 450. Please, 800 minus 450, what's the balance left?
350.
Now 350 minus 100, what's the balance left?
250.
250 minus 200, what's the balance left?
50.
But how much do they need? They need to pay the contractor 250, but they have only 50 Ghana cedis or 50,000. Then they also went into their general pool of fund and withdraw 200 Ghana cedis so that you add up to the 50 here and they can pay the contractor. So this make this question a mixture of both a specific loan and what? General pool of fund. So after this question, any other questions, you should be able to do justice to it. And we are good to go. So I'm done. Always start with a specific borrowing first. It's very easy to calculate specific borrowing. Because with a general pool of fund, you must first calculate the capitalization rate. What if your capitalization rate is wrong? You deal trouble inside. We are done. Now let's go straight to the next show. When I do this one, I have to do the next question. That one is difficult than this. The construction project was temporarily halted for 3 weeks in May. I don't understand why all issues have to be with May. And here may be June. So due to a substantial technical administrative work being carried out. So here, will you suspend or you continue? Suspend or continue?
Continue.
Good. It's assumed that management of ABC Limited adopts accounting policy of capitalizing borrowing costs. Yes, here is the choice. So it's a decision. It should be a policy. The following amounts of debt were outstanding in the entity statement of financial position as at 31st December 2010. Here, the examiner did not tell you when construction was completed in a question. You didn't see anything. So what you have to do is that you have to assume that the construction is done or ongoing. So you calculate your borrowing cost up to the year end. Take notice. When the date of completion and the date at which you must calculate the borrowing cost is silent, calculate it for the very first year up to the year end. So here, what will be the year end? What is the entity's year end? The entity's year end.
It's the 31st December 2010.
Good. So let all your calculation go and end there. Don't say that target. The examiner never informed me the end of the construction period. So let me do it for 2 years. You've been hot soup. Two things here. It means that the construction is ongoing. We have what to call ongoing projects. So you capitalize as it's going on. This information here will help us to calculate what we call the capitalization rate. I'll not give you the formula. I'll give you the formula. And I'm calculating it now. The following amount of debt were outstanding. So medium-term loan, don't use it. Because that was what they borrowed for the specific construction. So here you have to pick a free loans. So you have to use this to calculate your capitalization rate, starting from the overdraft. And then the 10% 7-year notes, loan notes. Now let me explain things to you here. Don't make this assumption that will lead you into trouble. It means that the general pool of funds, how much did they use? They used the first 200 and the last 200. So in total, how much they use for the pool of funds?
400.
Don't come and tell us that 400 the money is too small. I can get it for one of the loans. If one of the existing loans can pay the 400. So let me just look through one of the existing loans and use its rate. Even the bank overdraft can pay off. So let me use its rate. Or even let me use the 10% loan note because we have 9 million. It can pay off the 400. Please don't make this mistake. Find the weighted average cost of debt and use that one instead. I'm done. So to start work, I'm calculating the specific borrowing. This is it question, which question number? Maybe question 2 in the exams, A or B, maybe A. Right here. Please, for level 2 there. This one, let me tell you, no matter what you do, you get revenue calculation. No matter wherever you pass, you get revenue calculation. I don't know where you pass to understand revenue. IFRS 5. IFRS 15. I've done a lot of videos on this particular standard. If you don't have them, just say target, say hi. If you're already on an existing page, I will share them with you. If you're not there, then I will let you have access to it. So third exam now, borrowing cost to be capitalized. I always love the specific borrowing first. I always love to do that one. Give me two reporting currencies, two of the reporting currencies. Right here, specific borrowings is very easy to calculate. You don't need any rate computation. First, right here, interest. Please, when are we starting capitalization? So interest here, we should have calculated 1 full year, but because we are ending at December, and we are starting at 31st January, not 1st January. So how many months? From 31st January to the end of the year, how many months?
$11.
That's correct. $11 months. What is the interest rate on a loan? 9%. We borrowed how much? But here we cannot use the 11 month too, because the loan, we picked the loan when? 31st March. The loan came in 31st March, two of us. The borrowing cost itself will start, the capitalization will start from January 31st. That one is the general pool of fund. The general pool will start from January 31st. But for the specific borrowing, the loan was picked on 31st March. So ideally, the interest will start counting from 31st March to the year end. So please, from 31st March to the year end, 31st of December, how many months? Don't feel
9
shy.
months.
Never
9 months.
Never
9 months.
start to count your fingers. To avoid all deviation, March is not part, April part. So from April to December, that becomes solid 9 months, solid one. So let's go and put in 9 months interest. So right here, 800,000 times 9% times 9 out of 12. What do you get?
$54,000.
54,000. 54, right?
Yes, sir.
Now, anytime you meet a specific borrowing, do this. Draw extra table to the question and do this analysis for me. Number one, the loan was picked from here. So this money was free. How much left? How much balance left after the first payment? 800,000 minus 450 will give us what?
350.
And it will be free for how many months? It will be free for until the next month. So from 31st March up to 30th June, how many months? How many months?
3 months. It's not 3 months.
Good, that'll be 3 months. So that means we will invest 350 cedis for 3 month period. Let's go and do it. So right here, less what? Investment income. So say match investment. That will be 350,000. How much is the interest rate when they invest? What is the interest rate when they invest?
6%.
Good, that will be 6% when they invest. Times 3 months, what do you get?
Yeah, 5250.
Now let's go again. Now here we said I left a 350 series. Left a 350 series. 30th June, they pay 100. How much left?
250.
That 250 will be free for the next period. So from 30th June to 31st October, how many months?
Say 4 months.
Let's count and see. July.
July, August, September,
Correct.
October.
Good. So 4 months. So therefore, 250 Ghana cedis will be free for 4 months. So here they'll do the investment when? It was June. So right, the month they will invest 250,000 times 6% times 4 out of 12. What do you get?
So I had 5,000.
5,000.
Please, someone can also confirm.
All right, the next one that you have to do is that you continue the journey. October 31st. The thing I left with 250. They took 50. So it was free. So left with 50, two of us. This for how many months? That the 50,000 became free. How many months?
1 month.
Good. So 4 months. So in exactly, is it 4 months or 1 month?
One.
Okay. So let's do the computation together. It will be invested on 31st. No, just write October. This is what you get.
1,000 cities.
Just 1,000.
Yes, please.
Put all together, what do you get?
Uh, 11250.
1,1.
250.
What do you get? Please, what do you get?
Kayet,
Yes, please.
the October calculation, I had 250.
Hey,
Please check again.
that's why I asked
I
you.
had 250.
Please let's all
Please
confirm.
check again.
50,000 times 6% times 1/12. Answer.
250.
Did you all confirm that? 250, right? If you put them together, what do you get?
$10,500.
So what do you get as your net borrowing cost?
$43,500.
So borrowing cost from specific borrowing. Now, you can start to name it or leave it. Now let's go to the next show. General pool of fund. So we are continuing from this angle. Now, when you're doing the general pool of fund, first thing that you have to do for us is to calculate the capitalization rate. So workings. 1, capitalization rate. Here, put the interest here. Right here, interest. Put the debt capital here. Just write here, debt capital. Or write debt. And list all the debts that are free from the question. So let's go. The debt that are free. Medium-term loan is not part. Bank overdraft. The figure is 750. But it's so that the total overdraft interest charged by the bank is 33,800. So bring the interest. Write here overdraft. Please, you only pick interest-bearing debt. Debt that do not qualify for interest, don't pick it. We beg you. A debt that we don't pay interest on it, don't pick it. A debt that is not free, don't pick it. Some of the debt, they will tell that it was constructed or acquired or secured for a particular project. Don't pick those debts. Pick debt apart from those I've mentioned. and the debt is 750. We are true.
Target.
Yes, please.
Target. Please, my network went off.
Oh,
So
okay.
I didn't. So please, so after the deduction, what next?
Then you write general pool of fund. Because in the question, there is general pool of fund in the question. If there's no general pool of fund, you are done. You end here. But in this case, there's general
Okay.
pool of fund, so you have to continue. When you do a general pool of fund, your first thing is to stop and go and calculate your capitalization rate,
Okay.
in which you pick all the debts that are free. Never touch a debt which is not free, such as a debt that has been acquired for a particular purpose. Practical example, in this case, you see that there's a middle term loan here, 800.
Yes, sir.
It has a purpose, so don't pick that one. We beg you.
Okay.
Because it was borrowed for a particular project. Don't pick that one. We beg you.
Okay.
Debts that are free. Another item that we don't pick. Any debt that do not, there's no interest payment on it. Don't pick those ones. We beg you. So if you see government interest-free loans among the list, reject them. I'm done. Now, so here we saw bank overdraft.
Yes, sir.
Because they brought a total in overdraft interest charged by the bank here, you pick them because there's interest. The next one, you pick the interest and pick the principal. Go and put them down. The next one is 7-year loan notes. The interest rate is 7%. No, sorry, 10%. The principal is 9 million. So let's go 10% principal, 9 million. So right here, 7-year notes. As they've done it. Do your calculations for me. The principal amount is 9 million. So, and the interest rate is what?
10%.
So 10% on 9 million will be what? That should be 900,000.
900.
This is how, so even if the debts are plenty, list them like this, one after the other. When you're done, sum everything up. Get your total. So it will be 933,800 series. It will be 9,750,000. That's it.
Nice.
And what do you have to do? You now say the capitalization rate is equal to total interest divided by total debt capital, which is 933,800 divided by what? 9750,123 times 100. What do you get? Round it to the 3 decimal places.
750.
No, 2 decimal places, okay. 2
Yes.
decimal places.
Target, are we invited?
It's what happened. Nothing happened though. It was a network error. It was a network error.
Okay.
Target 9.58.
9.58%.
58. Mhm.
That's the first rule. Rule number 2. Go back to the When did they use the general pool of funds? They used it on 31st January. So please, 31st January, up to the year end, how many months?
12.
11 months.
Hey, 11.
So 11
February.
months.
February.
So you say the January own will be, open your bracket nicely. Tell the examiner that is equal to the amount they picked times the capital. They pick 200 Ghana. So 200,000 times what rate?
9.58.
Percent. Times how many months?
That's 11 over 12.
Good. So please, what do you get?
That is 17,563.33.
17,000, comma.
563.33.
563. Let's throw the point away. So the next, again, they also use the general pool of fund somewhere November, 30th of November, 2000 and what? 2010. So they use 200,000. So from 30th of November to 31st of December, how many months?
1.
Good. So that is that. So you write here November. Open a bracket. So 200,000 times 5.98% times 1 out of 12 is what you get.
The interest is 9.58.
9.58. Wow, 5.98. This is a transposition. 9.58. Please, what do you get?
159,666. 159,666.
1 5
599 666.
like this,
Another one.
like this.
Yes, yes. 0.66.
Hey, I might not agree. Oh. The figures are plenty. Oh.
This one.
Mm-hmm.
That is correct.
It's 1596. Let's take it 97.
Oh, okay.
1597.
Okay. Like this.
Yes.
Just add the general pool of funds together for me. We are adding just the general pool of funds.
Oh, okay. 5% now.
Add the general pool of fund figures together for me.
One 19160.
19160, comma
160.
so now put everything together plus 43,500. What do you get? Plus 43,500.
62660.
626.
60.
Is it like this?
No. 62660.
Oh, okay. So this is a total borrowing cost eligible for capitalization. Please, as to stand for this question, it ends here. You are done. But I'll never end here. Let me go further. Number one, though the question ends here, when they ask you to find the total current amount at the date of completion or total cost of the building, bring the construction cost here. What's the construction cost? Who can tell me the total construction cost? Total construction cost will be how much? Total construction cost. So many ways to get it. The long approach is that add all these figures together. The shortcut approach is that pick the loan they pick, 800, add the general pool of fund, 400. This is what you get as the total cost of construction.
1.2.
So write it here. What's the total cost of the building? Total cost of the building. As at now.
1262660.
1262,660. Now, what if two things here? What if at this date they have completed all activities? if they have complete all activities, including finishing, oh, please, to make the asset ready. Finishing is part of the activities, not just construction.
Different depreciation.
1, depreciation will continue. Depreciation, consider time apportionment. Time apportionment, mostly. Normally, they finish within the half a year. The rest of the half continue. What if it's ongoing project? Ongoing. No depreciation. Right balance carry down. What if the following year they incur another borrowing cost? Then you are accumulating it, you are calculating it, you are adding up. So this will be for year 1. Imagine this is 2010. Imagine in 2011 they continued. So you still calculate the borrowing cost eligible for capitalization in 2011. After getting the answer, bring the total cost brought down of 1,262,660 and continue your work and go. You put the two together, but I've not seen any question of that nature before. With the ICAG exams, elsewhere I've seen it. I've seen a couple of questions elsewhere, but it has not gotten to ICA. I'm sure one day it will find its way into your exams. On that note, I'm done with the borrowing course. Everything about borrowing course we are done today. The rest is for you to go through other questions. I've done a lot of questions. Go on check on our videos on YouTube on borrowing course. The other videos, you see a lot of questions we've done. And we are good to go. Please share this to your friends. Let them enjoy target postal videos. All right, so to get the material, you have to let us know. Then we'll prepare it for you. At a little token, not even a full few. It has been discounted. At a little token. Just covering for the preparation course. All our classes, intervention from now you write exams, they are free.
Taye, please, you said Monday we are.
Come again.
Please, you said on Monday we are not meeting.
Monday, we are starting our intervention on Monday. Our last meeting is tomorrow. Sunday, we are meeting between 7 p.m. to 10 p.m. specifically still on consolidation and other IFRSs for level 3 on Monday. Sorry, on Sunday. Then Monday, we'll do the check on the various pages. Right after today's section, I'll shoot the intervention timetable and then timing and everything on the page for you. All right, so if you have any question, suggestion, contribution, you can let us have it.
Target, please